Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rama Mohan Rao Amara, MD and CEO, SBI Card. Thank you, and over to you, sir.
Thank you, Yashasri. Good evening, everyone. I am pleased to welcome you to the Q4 and FY23 earnings call. I really appreciate your presence today. As you would know, while global economy remains uncertain due to many factors, including geopolitical ones still persisting, it seems to be inching towards improvement, with IMF predicting the growth rate bottoming out in 2023 to 2.8% before rising to 3% in 2024. Amidst this, economic activity in India remains resilient. The real GDP growth is expected to be 7% in 2020-23 as per RBI. Both PMI manufacturing and PMI services remained robust in March 23 at 56.4 and 57.8 respectively. Aggregate demand conditions remained resilient in Q4. According to RBI's recent consumer confidence survey, consumer confidence continues to improve. Most importantly, the survey showed that household spending was buoyant on the back of higher essential and non-essential spending. And more than a third of the households expect a rise in non-essential outlay over the next year. This is a good sign for consumer demand and discretionary spends. Apart from its comparative economic resilience during these times, India is also being hailed as a front runner when it comes to digital payments. This is true when we look at aspects like innovation in payments, the pace of its adoption among population, and the vast user base. According to a recent industry report, India's digital payments market will increase from $3 trillion to $10 trillion by 2026. Credit cards too continue to ride this digital payments growth wave. Credit card base grew from 73 million in March 22 to over 85 million in March 23. This is despite the closure of around 12 million inactive cards by the industry. Card spends have also increased significantly by 28% from 1.07 lakh crores in March 22 to 1.37 lakh crores in March 23, the highest ever monthly spends for the industry. Card spends continue to remain over 1 lakh crores for last 13 months, with e-commerce contributing to a significant share in the spends. It is interesting to note that in FY23, the industry saw highest ever annual card spends at rupees 14 lakh crore plus. In FY23, the industry saw the highest festive season card spends during October at rupees 1.29 lakh crores, and a strong winter holiday season added to increased travel spends as well. This clearly demonstrates the robustness of the demand and usage for credit cards. In fact, the past year has been a pivotal year for the industry, with many significant changes to the business model that have set the tone for future of credit cards industry. The industry has largely adjusted to and incorporated these in a seamless manner during the past 6 months and is now ready for the next level of growth. I would like to reiterate my confidence in India's credit cards market potential. The significantly underpenetrated market offers ample growth opportunities to all the participants. Let's now look at SBI Card's business overview in FY23. I am proud to say that the SBI Card was successfully able to navigate through the year and register a robust business performance, demonstrating the resilient and sustainable business model that we have built over the years. As always, we continue to create value for our stakeholders, and I am pleased to share that we declared an interim dividend of rupees 2.5 per equity share for FY23 in the month of March 23. Throughout the year, we put focused efforts on 3 aspects, namely strengthening acquisition channels and acquisition quality, enhancing sustainability of the business, and ensuring an engaged and active customer base. As a result, during the course, we have achieved some new benchmarks. We added 5,202,000 or 5.2 million total new accounts in FY23, which has been the highest ever during the financial year. In FY23, our new accounts grew by about 46%. During Q4, we added 13.71 lakh new accounts at a growth rate of 37% year on year. We continue to focus on adding about 900,000 to 1 million cards per quarter on net basis, and in line, we have added 900,000 cards in Q4. Our cards imports stood at 1.68 crores in Q4FY23. We continue to be the second largest credit card issuer in the country, and our cards outstanding, in terms of cards outstanding, market share improved by 100 basis points to 19.7% during FY23. Our spends have also seen new heights in FY23. SBI cards saw the highest ever retail spends in FY23 at over 2 lakh crores, which is a 41% increase over FY22. Our card spends in Q4 stood at rupees 71,686 crores, with a 32% year-on-year growth, and this is the best ever quarterly spends at SBI card. Out of this, retail spends contributed over 55,500 crores, with 33% year-on-year growth in Q4 FY23. Again, the best quarter for us in retail spend. It is noteworthy that our retail spends per card has also increased by 7% year-on-year in Q4 FY23. On that note, I am pleased to share that we are number 2 position in the spends market share. During Q4 FY23, spends growth on quarter-on-quarter basis have been driven by growth in categories like departmental stores, health, utilities, education, consumer durables, furnishings, and hardware, etc. Travel, entertainment, and restaurant category also saw good growth. In fact, Q4 FY23 has been the first quarter in last 3 years to surpass the travel spends momentum seen in Q4 FY20. Online retail spends continue to grow in FY23, reaching a 56.9% share of total card spends. Our continued robust business momentum also helped us register healthy financials in FY23. Let me share some key ones. Our total revenues today is 14,286 crores and has grown at 26% year-on-year for the year FY23. Our revenue from operations has seen 28% year-on-year growth in FY23. Our receivables continue to increase steadily. Receivables at 40,722 crores have grown by 30% as compared to rupees 31,281 crores in March 22. The share of interest earning assets has improved to 61% in March 23 as compared to 59% in March 22. In FY23, SBI card has achieved a PAT of rupees 2,258 crores, registering a significant 40% growth over FY22. SBI card undertook some significant initiatives on the product side during FY23. We further expanded our core card portfolio and added cashback SBI card, a clutter-breaking product. Since its launch, the card has seen very encouraging response from the consumers. We launched a new co-branded card, Aditya Birla SBI card, in partnership with Aditya Birla Finance. We have been working on several initiatives in strengthening our acquisition channels and enhancing customer experience. Technology has been playing an important role as we bring these to fruition. I'm talking about SBI Card Sprint rollout. SBI Card Sprint is an end-to-end digital acquisition channel and has been a significant initiative to be launched during the year, which has made enrollment for customers easier, seamless, faster, and instant. This allows the customers to get a card in just 5 to 7 minutes. Digital KYC enhancement. We have launched several initiatives to digitize the KYC process across the customer journeys to enhance the security and convenience for our customers. Multiple modes, namely biometric eKYC, DigiLocker, video KYC, etc., are used for customer needs. It is noteworthy many such efforts are helping us in rationalizing the cost acquisition, thus bolstering the business fundamentals. We are excited with the opportunity from the linkage of RuPay cards with UPI. Access to a large merchant and hence customer base is good for the industry players. We plan to roll out the SBI-RuPay linkage over the next few months. Speaking of business viability, it is important to note that a higher customer spends active rate is vital. And at SBI card, our spends active rates have always been healthy at 50%, including in FY23. We continue to have a full strength and highly capable senior management team to lead the company towards new phase of the growth journey. I am proud to share that this year too, all-round efforts have been duly recognized. SBI card has earned various prestigious recognitions in different areas. For instance, ET Best Brands 2022 Award, TV Award for Customer Service, and Golden Peacock National Training Award for Excellence in Training and Development Initiatives. Coming to the financial performance in Q4FY23, our total revenue in Q4 has been at 3,917 crores, registering a growth of 30% year-on-year. In Q4, our revenues from operations have been at 3,762 crores with 32% year-on-year growth. In Q4 FY23, our PAT grew at 596 crores, registering a 3% year-on-year increase and 17% quarter-on-quarter growth sequentially. In FY23, as expected, owing to consecutive interest rate increases, our cost of funds has also witnessed a significant increase. As we communicated last quarter, our cost of funds increased by 39 basis points in Q4 over Q3. We were able to minimize the impact on NIM, and our NIM for Q4 is only 5 basis points lower at 11.5%. Our cost to income for FY23 was at 58.9%. We saw an improvement in cost to income ratio to 58.1% versus 61.9% in Q3 FY23, with spend-related expenses being lower this quarter. On asset quality, our NPA increased marginally in Q4. GNPA stood at 2.35% as of Q4 FY23. Our gross credit cost increased to 6.3% in Q4. We revised the model estimates this quarter, which I'm talking about ECL model. We revised the ECL model estimate this quarter, which resulted in a one-time impact of 20 basis points on the credit cost. Adjusted for that, our gross credit cost would be in the range that we have shared always, 5.8 to 6% plus, that is 6.2%. We have identified a sub-segment from the legacy portfolio that has contributed to higher slippages in last few quarters, impacting the NPA and write-off numbers. We have taken portfolio actions and expect that with actions taken, we will be able to address the issue. The new acquisition from 2020 vintage onwards is behaving as per expectations in terms of delinquency. Our profitability ratio also continues to improve. In FY23, our return on average assets increased to 5.6% versus 5.4% in FY22. In Q4 FY23, it has been at 5.4%. During the year, our return on average equity has also seen an increase, reaching to 25.3% versus 22.8% in FY22. In Q4, ROAE has been at 24.6%. In conclusion, India remains resilient and the domestic consumption remains encouraging. At SBI Card, as always, we have maintained an agile approach and taken well-calibrated measures to ensure that the company remains on sustainable and profitable growth path. Interest rates remain elevated, however, these have been factored in and are likely to stabilize from here. With such growth momentum and most key policy measures too now largely in place, the credit card industry is likely to witness sustained growth momentum. I would also like to share that this year SBI Card will be celebrating 25 years of its immensely successful journey. We look forward to celebrating this with all our stakeholders. While we look at the last 25 years journey with pride, we believe that the future is much more promising. So now we are open for questions. Yashasri.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, good evening, sir. So my first question is on credit cost. You already explained that there was a one-time impact of change in ECL assumption. So if you could elaborate on the change, and also in general, for the industry, revolve rates have come down a lot post-COVID. So why are credit costs still sticky? Is there scope for them to come down? Because if revolves are declining so much, then credit costs should also be lower is the general sense.
I think this one-time adjustment with an impact of 20 basis points is in terms of strengthening the ECL model, where we stress the model and based on the current economic factors, macroeconomic factors, we further modified the model, which has resulted in a some around 20 crores kind of impact in a quarter. Yeah, annualized returns, it works out around 20 basis points. In fact, if you adjust the credit cost for this 20 basis points, it's around 6.1%, which is at a higher end of the spectrum what we have given. I talked about a broad range of 5.8 to 6.2% credit cost, which takes into account the current composition of the asset, the current share of revolver, transactors, EMI loans, current economic conditions, current the kind of environment in which we are operating, and the recovery culture, all that stuff. So we are at a higher end of the spectrum. As I communicated earlier, we have identified the segment very clearly. We have been taking portfolio action. We are expecting that credit cost will have a trajectory of coming down in the next 2 quarters. It will come down.
Okay, sir. Thank you so much.
Thank you. We have our next question from the line of Karthik Jalapa from Indus Capital Advisors, Hong Kong Limited. Please go ahead.
Yeah, thank you very much for the opportunity. Am I audible, sir?
Yeah, Karthik.
Okay, great. 2 questions from my side, sir. Over the last few quarters, we have seen a very good recovery in our card volume share, which is at about 19.7%. But if I look at the difference between our card volume share and spends share, which is almost close to 1.5% now, that's almost at a 9 to 10 quarter high. So given that we have got really good momentum on the volume side, why is it not reflecting in spends yet? Is it a reflection of the quality of customers that we are getting, either geography-wise or self-employment versus salary-wise? And at what point of time do you think this difference narrows down?
While I will respond to your query, and Girish also can supplement. One thing is, the spends comprise both retail and the corporate spends. So we have seen the kind of volatility in the market share in terms of the spends. Whenever the corporate card spends move from one place to another, it has a significant bearing on the spend share. So being mindful of that, and also being mindful of the fact that it is only top line, it doesn't add much to the bottom line, but it can potentially bring in risk. We have been playing a very calibrated game here. That's the reason our corporate card spends actually account for it. It's a range bound. It is 22 to 25% of our overall spends. But with regard to new issuance, where you have also commented about our robustness in the volume, as you know, it takes some time for the customer to start using the limit fully. They may start with a smaller transactions to begin with, but the moment they experience the benefits of using the card, they will start using it for discretionary spends, etc. And then you can see a large ticket transactions. In as much as the volumes have come only post-COVID, after 2020, I think there is a catch-up here. In terms of being equal to the portfolio, it will take time for the new vintage. Anything you want to add?
So Karthik, in the new customer acquisition that we are doing, these days, because of the RBI guidelines, you have to keep the customer active, and if the customer is inactive for more than 12 months, in any case, that customer gets purged off your portfolio. So what we are seeing is that all the new customers that we are getting, their average spend actually is coming out quite better and higher than the earlier vintages that we are getting at the same point of time. So which is a good sign. The second thing which is also visible in the portfolio is that these customers their active rates are also higher in terms of, let's say, a 2-month, 3-month, 4-month active rate. So they are also higher. So we don't see an issue there. As Sir was mentioning, the issue on the market share primarily is because of the mix that we are targeting of retail versus corporate spends. So there will be some banks which will target a higher corporate versus retail mix. So it will the shares will look very, very different. When we check, because there are other sources through which we check, we see that average retail spend of ours is similar to the industry number.
Let me just add, even on the slide number 8 in the deck, you will see that our Q4 FY22 retail spend per average card was 124,000, and it's gone up to 136,000 for Q4 FY23. So there is an increase that you can see already in the retail spend per average card. And since a lot of sourcing for us has happened in the last 1.5 to 2 years, there is a bit of catch-up as well, which will start reflecting, but already we are seeing the benefit of the spends going up in metric on spends per average card.
Got it. This is very useful. My second question is basically on the new RBI direction on pre-sanctioned credit lines through banks using UPI. Now, although the details are yet to be unveiled, is there any thought process on how it's going to be impacting credit cards?
So, as you rightly said, that there are guidelines still fully yet to come, but these kind of products are already available. So, people were already giving, because UPI is essentially, in a way, if you see, for a debit card to make a transaction online, that model is there, and OD limit on the bank account or debit cards are always there. So, we will also see as to how this goes further, but this is just a different version of the earlier product which was available.
Got it. Okay. That's it from my side. I'll come back in the queue for more questions. Wish the team all the very best for the next year.
Thank you. Ladies and gentlemen, in order to ensure that management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We have our next question from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. So just wanted to understand the nature of slippages that have happened in this quarter. What is the vintage of the customer, and is it coming from salaried or self-employed? Some color around that. Second is that if you look at the originations, they have picked up in the self-employed category in the last 2 to 3 quarters. So if you can touch upon what is the customer profile of these customers and what is the origination channel for this? And lastly, if you could share some guidance on NIMs and cost of funds for FY24. Thanks.
I think with regard to the vintage, we did see, as I clarified in my speech as well, the new vintages are holding good in terms of whatever expectations we had in terms of a very broad delinquency band and a ECL kind of consumption. They are behaving normally. There is no issue around that. But in the legacy vintages, we did identify a small customer base which was showing a higher delinquency. Obviously, that was resulting in higher flow rates and then higher NPA and eventually leading to higher write-offs. This segment was identified. There is nothing can be pointed out. This is all across in terms of geographies and the nature. So we are taking portfolio actions that are required. So we are confident that actually, as the weightage for the recent vintages increases, and as we are the actions taken on this particular segment shows the results, actually the credit cost will trend lower. With regard to cost of funds, I will ask Rashmi to.
So on the cost of funds, we saw one post the actions taken in Q3, which obviously resulted in the cost of funds going up in Q4. There has been one more action by RBI, which is a 25 basis points increase in February. On account of that, we do expect that the cost of funds for Q1 FY24 will be higher by about 10 to 15 basis points. It seems from the statement that RBI has made so far, while they did mention, the governor did mention it's a pause and not a pivot, we do not expect any further rate hikes from the RBI. If that is the case, I would expect that the cost of funds will stabilize for Q2 and maybe start to inch down in the second half of the year. And on the NIM, therefore, the corresponding impact will be that while we've been able to maintain the NIMs in Q4, very marginal dip from Q3, we do expect that the NIMs to stabilize over Q1 and Q2, and any benefits coming in from the cost of funds and also any actions that we have been taking, which we took in Q4 and will be taking further in Q1 on the customer yield, will help us strengthen the NIMs in the second half of the year.
Sure. So just on the follow-up on the first reply, the earlier vintage customers where we are seeing delinquencies, are these pre-pandemic originations? Just to confirm, and also on the self-employed originations, if you can just touch upon that question is pending.
Yes, the portfolio that Mr. Rao did mention is a pre-pandemic portfolio. It's a sub-segment of one segment that you identified, which was originated pre-pandemic.
Sure.
And it's a mix. I think your question was, is it self-employed? The answer is it's a mix of self-employed salary. But we've taken corresponding portfolio actions based on whatever further sub-segmentation that we can do.
Sure. Thanks.
Thank you. We have our next question from the line of Bhavik Dave from Nippon. Please go ahead.
Yeah, hi, good evening, sir. Hope I'm audible. Sir, two questions. One is on your cost of acquisition, in the sense that when we see our incremental cards that we are adding, in the last 4 or 5 quarters, we've been adding cards in the tier 3 plus tier 3, tier 4 regions. Just want to understand, is the cost of acquisition very similar when we do metro acquisitions versus tier 3, tier 4 acquisitions? That is point number one. And point number two is, when we see quarter to quarter, the operating expenses haven't fallen that we've seen last year, same time. What would be the logic, or what has led to this cost of other operating expenses being flat? Within that, the fees and the commissions have increased by 5-10% quarter on quarter. Just want to understand what exactly is happening here. And to that, just want to understand, going ahead, can operating expenses come out lower as a percentage of our income, considering we are doing this online channel that we've opened up incrementally? So just want to get a sense on that. Thank you.
So cost of acquisition on a year-on-year basis, we have seen a downward trend. It's actually 10% plus downward trend that we have seen in the cost of acquisition. Because you mentioned metro versus tier 3, tier 4, while we do not look at it from that perspective, but we can tell you that banca cost of acquisition is lower than open market cost of acquisition, and for the natural reasons that in the banca scenario there is a kind of leads which is available from the customer. Apart from this, there is a constant effort on the digital side of things to bring the cost of acquisition down. As going further, as we go more digital, and we, as MD sir mentioned, that we have launched the sprint journey, where you can get the card within 5 to 6 minutes in your hand. As more number of customers pass through that, and we are able to generate more volumes there, the cost of acquisition will further trend downward.
I think your second part of the question was the operating costs have been flattish quarter on quarter. Is that what you're asking?
Yes, and last year, same time, third to fourth quarter, there was a dip. Just want to understand, if you see this quarter versus last quarter, the number of cards that we added, the gross additions were lower, right? Like 1 million cards versus 900,000 cards this quarter. Just want to understand, why are we seeing the cost of other expenses going down quarter on quarter?
So the reason for the cost to be flattish quarter on quarter between quarter 3 and quarter 4 are certain IT expenses that we've done, certain projects that we have started in quarter 4, and the cost of that has come in. So while you're right that the cost, and as we should explain, that the cost of acquisition quarter on quarter has been coming down, the overall operating cost is higher due to certain project costs taken up in quarter 4.
Sure, and this will now cost of acquisition going down should benefit us in FY24, right? The cost should not, except our rewards and promotional expenses that we do, except that the other part of the cost structure should trend flattish or lower, right? And is that a fair assumption?
On a quarter-on-quarter basis, there can be some variation, because in our model of acquisition, there is, if we acquire through digital, then the cost is very low. But otherwise, if you do through manpower, there is a set of fixed costs, and then there is a set of variable costs. There is usually some amount of variation, and that happens on a quarter-to-quarter or a month-to-month basis. But on an annualized basis, we will be trending down.
Sure. And last question is, out of the 900,000 cards that we added, the online, the sprint journey, how much is that contributing?
Thank you, sir.
Yeah, sure. This is the last question. How much is the sprint journey contributing to our 900,000 cards? And how is it trending? That's the last question. Thank you.
So as of now, sprint does not contribute much large percentage into it. It's a very small percentage. The reason primarily is that as of now, we have kept it only for purely digital and for cashback card customers. In that sense, we are slowly integrating it with our partners. So as of now, the process of integrating it with our co-brand partners is on. One is already done. The other partners is in progress. We also want to integrate this sprint journey with our banca, or with the banca, with along with the internet banking. So these are the things which is in progress. So once that happens, more number of customers suddenly can express and use this sprint journey on a regular basis. So we expect this to rise rapidly now that we have tested that it works absolutely fine and the customer can be given a card within 5 minutes.
Thank you. We have our next question from the line of Bhavesh Kanani from ASK Investment Managers. Please go ahead. Mr. Bhavesh Kanani? Since there is no response, we'll move on to the next question from the line of Alpesh Mehta from IIFL AMC. Please go ahead.
Yeah, hi sir. Am I audible?
Yes.
Okay, hi. Sir, two questions. First is on the yield on loans. We have seen the sequential improvement in the yield. So, what has been the increase into the personal loan segment related?
Yes, please use the handset.
Can't hear you.
Handset.
Yeah, just one. Can you hear me now? Hello?
Yes,
Yeah,
please
better.
go ahead.
Yeah, so the...
I'm sorry to hear you again. Since there is no response, we'll move on to the next question from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Good evening. Thank you for the opportunity. Two questions. One is, given the fact that the revolvers are still range bound, what are the new revenue line items that we are looking at or we want to develop? That's the first. Second is, what is the margin contribution difference between retail spends and corporate spends?
You have to repeat the first question, Subhranshu. We got the second one. What was the first one?
Sure. So, given the fact that revolver as a proportion is lower or range bound, so the interest income is therefore getting mitigated. So, what are the new revenue line items we are looking at or focusing on, which can be incremental to the top line of that?
But I think revolver is steady. What are the other line items are we looking at, revenue line items to enhance the revenue?
I think we have stated in the past that we will be looking at the revenue optimization through the cross-sell. We have various products like Encash, FlexiPay, we have balance transfer and the subvention on these products are there. We are, of course, we are also adopting a risk-based pricing to be more competitive also in the market and we are also looking at what are the other risk mitigants that are available to expand our base that is eligible for availing these products. So that way we have steadily increased the share of this interest-bearing NEA. If you look at overall revolver plus EMI, it has increased by 2 percentage points over a year's time. So this endeavor will continue. But of course, we will also be looking at the fee income, what are all the other ways and means of supplementing some of the revenue lines that got evaporated, particularly after some changes have come into effect from 1st of October. We did notify the market and the stakeholders. We have introduced 2 types of fee. So we will continue to look for kind of avenues to augment our current state.
Margin contribution to retail spend.
Second question is the margin contribution in retail spend and the corporate spend.
So on the corporate spend, the margin contribution is very minimal because whatever we earn as primarily interchange gets passed back to the customer in the form of a passback or an offer. So on the corporate side, the contribution is fairly minimal. On the retail side, while we get interchange, but we have to give customer reward points. So there is the element there, and we also give up to 52 days of credit-free period. So these are the 2 major things. After that, there is a margin which is still less. We also make money from fee and charges, also from interest income. So there are multiple other sources in the retail scenario. There is in case of corporate because it is customer pays 100%, so there is no interest income.
Thank you for that. If I can squeeze in one last question, what kind of spend growth are we looking at in 24 and 25? Thanks.
So as per industry sources, we believe that the spend should grow anywhere between 22 to 25%. We will try and keep an alpha on top of the industry numbers.
Thank you. We have a next question from the line of Alpesh Mehta from IIFL AMC. Please go ahead.
Hello, am I audible now?
Yes.
Okay, just two questions, sir. Firstly, on a sequential basis, we have seen around 30-40 basis points improvement in the yield. So what kind of pricing action you would have taken onto the EMI segment, because the mix is largely stable on a QoQ basis?
I think, as I said in the past, we adopt a kind of risk-based pricing, which permits like a kind of transmission of the rate whenever the funding cost increases or whenever the other costs increase. We also can transmit back to the customer. So that is a strategy that was adopted last quarter when we revised the prices for some of these loan products. I talked about Encash, talked about FlexiPay and other loans. So we were able to successfully transmit the rate for the new disbursements. Because unlike kind of others in the industry, where the entire portfolio gets reset because they are linked to the external benchmark, in our case, mostly the loans carry fixed rate. So the opportunity to transmit the rate is only with respect of new disbursements, which we were able to do successfully last quarter.
Okay, and there is no change onto the revolve yields, right? Revolve yields remains the same? Because I believe we would be at the...
There is no change in the APR. Revolver remains same, and the share in the overall asset also remains same. So obviously, there is no change in the revolver contribution.
Perfect. And just the last one, if you can throw some light onto the instance-based fees and the others, because that contribution has gone up sequentially. So any major line item that would have contributed more in this quarter?
The instance-based fee, just give me a second. Yeah, the instance-based fee was higher, largely because if you recall, we reduced the fee on the rentals, and we also increased that fee from 99 to 199 in the month of March. While of course the impact of that increase is minimal, given that the number of days that it was effective for was less, but a significant portion of that increase has come from the rental fee.
Okay, got it. And
so this was a major contributor.
Perfect. And lastly, the 20-25% increase into the spends growth that you are factoring in, that does not include does that include any action on the rental payment side as well?
So the 20-25%
growth onto the spend side that the industry is expecting, since now on the rental there are no rewards and some fees are also introduced on that. So do you expect that to be stable, or that could see some drop in the spends growth?
No, should not, because in between Q3 to Q4, as Rashmi was mentioning, in Q3, mid of Q3, we levied 99 rupees as a fee. And in March, we increased it to 199. We have not seen any drop on a month-on-month basis from Q3 to Q4 on the rental spends. So while absolute growth might not be similar to industry level growth, but it will still remain stable or marginally growing.
Thank you. We have a next question from the line of Anand Dama from MK Global. Please go ahead.
Yes, sir. Thank you for the opportunity. So firstly, on the NPS front, which have gone up quarter on quarter, and our credit costs also have gone up, where you said that ECL provisions have been rising. But just wanted to check, whether these NPAs have come, or the stress has come primarily from the monitorable or the identified stress pools, or this was all of a surprise that basically came through in this fourth quarter. And if we have typically do the exercise of identifying the stress, then is there any pool that you can talk about that you have identified or that you're monitoring at this point of time?
I think you will have to repeat the question. I think most part of it was audible.
So basically, sir, one is that the NPA flow that you saw during the current quarter, was this basically out of the identified stress pool, or basically this was all of a surprise that we saw in the fourth quarter?
The question is that the NPA increase that we've seen, is it largely from the identified stress pool that we called out, or is it across?
Or it's surprise.
Yeah.
So I talked about the small segment having a higher delinquency. It means like you expect a kind of contribution from the legacy portfolio, some new vintages, everything. But this segment, what we identified, has a higher propensity to become delinquent. So, and because we have seen the recovery efficiency or collection efficiency in this segment, we noticed there is actually stress there. That was the reason we have taken some portfolio actions there in terms of minimizing the cross-sell or not offering the cross-sell. And other portfolio actions that are available, we've taken a few and some more are on the anvil. But again, as a part of repetition, the latest vintage is behaving exactly as per our expectations. So we expect that these actions will eventually result in a kind of lower credit cost over a period of couple of quarters.
Okay. But going forward, like, running into the first quarter, do we have any kind of stress pool that you have identified already? And if yes, if you can quantify that?
We quantify for the next quarter.
I think, as I said, it's a work in progress, but some of these things will also take time. But we are very confident that it will have a downward trajectory. I think a quarter will be a kind of stabilization period before it actually starts evidencing a kind of real drop in the rate. But of course, this one-time kind of thing, what happened is not expected to repeat in the next couple of quarters because it's purely a model-related adjustment. So we are confident that the overall credit cost will maybe it will not cross the upper band whatever we have given. That confidence is there, but actions will take time. But over a couple of quarters, definitely it will come down.
Thank you. We have our next question from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi. Two data keeping questions and one qualitative question. The first is on to Rashmi ma'am. Can you just explain what explains the sharp increase in business development income, and also how do you account for recovery from previously written off accounts? Does it go to the non-interest income line or is it adjusted against the write-off provision? Sorry.
So the business development incentives are basically the milestones. These are kind of milestone incentives that we get from our partners. These are basically contracted, how should I say, slab rates in a way, in terms of the issue on a particular network and also on the spends that we do on those cards.
Yeah. In a sense, what explains this jump for the quarter?
So I think the jump is explained basically by the sourcing of cards that we did in quarter 3 and quarter 4, and also the higher spends we saw in quarter 3 and quarter 4. So while most of it was seen around December or so, but the impact of that has come in quarter 4 only, largely.
Okay. And recovery from written off?
Recoveries from written off go into our other income as bad debts recovered.
And this gets clubbed under instance-based fee, right?
It gets, sorry?
Where would you club this income in the non-interest income line? Which line item?
It goes into the other income line. So if you look at our financial statements and if you pick up the other income line, there would be
the 154 crores.
Of that as bad debt recovery.
Okay. And the qualitative questions are to Girish probably this question. If you look at your card book today and you look at the let's say the below prime segment, how has been that spend category? How is that spend category set of customers kind of where are they in the journey of recovery post COVID right now?
So Mahesh, after the let's say customers with vintage which was pre-COVID, on their spend journey they have all recovered back. In fact, they had recovered back long. I would say almost a year back. They have recovered back. New customers which we acquired during COVID, they were showing some bit of depressed spends in the year 2021, and it is that catch up, as MD sir was mentioning, which is now happening, and it has we have seen that this has happened this year. New customers acquired during this last I would say 15 to 18 months are showing very good spending behavior, very good activation rates. We have, as you have been seeing, we have been focusing on more younger customers where the activity rates are far better. So, from a spend perspective, on an overall basis, I think it's already caught up. There is only one category of spend, which is international spend, where I believe that there is still more opportunity. The balance has broadly reached higher than COVID. In fact, on the travel side, we have declared some of the numbers also. So this is the first quarter in Q4 after FY20 that we are indexed at almost 140% of what we were in COVID on the travel, specifically on the.
In a sense, the choice of spends that they seem to be taking still seems to be overwhelmingly on the EMI side rather than revolve. That journey has still not happened from that segment.
I would state that if I look at spend conversion to EMI, that spend conversion to EMI, if I take out the rental spends, because rental typically is more of a transactor spending in nature, if we take out the rental spends, our spend conversion to EMI, actually that percentage has become higher. So that number has gone up compared to what it was pre-COVID number. And that trend is fairly visible across segments. And when I'm looking at conversion to EMI, it is either at the point of sale or after you have spent and before payment due date you have converted to EMI.
Thank you. We have our next question from the line of Gao Zizuan from Schonfeld. Please go ahead.
Hey, thanks for the opportunity. Am I audible?
Not very clear, sir. Can you use your handset, please?
Yeah, am I audible now?
Can you
Yes, we can hear you.
please?
Am I audible?
Yeah, you are.
Thanks. So just follow up on the cost of fund comment. So basically, you are saying that because of repo hike last quarter and then the first quarter 24, we will see 10-15 basis points increase in cost of fund. And then after that, because RBI have already paused, we should not see any increase in cost of funds, right? Confused because if I look at historically, when RBI was cutting rates back in 2019 and early 2020, the repo rate bottomed about 4% at June 2020. But if I look at our cost of funds, it only bottoms about 3-4 quarters later. So there's a timing lag in terms of calculation of the time when repo paused or bottomed to our cost of funds stabilized, right? So just wondering why this time the cost of funds should immediately stop increasing the moment RBI stop hiking. I thought 25-30% of our funding is from NCD, which should reprice with a bit of lag, right?
Your comment is that the cost of funds, why is it increasing when the RBI has still paused?
Why it should not?
No. Yeah, why? Because you guys are saying that second quarter FY24 cost of funds should stop increase, right, sequentially, because RBI have paused.
Yeah.
But historically, our cost of fund repricing, if I just look at most recent episode where RBI was cutting rates, your cost of fund is still declining, 3-4 quarters after RBI stopped cutting rates. So on the way up, shouldn't there be a repricing lag as well? So our cost of funds should continue to increase a bit, even even after RBI pause? Because, some of our funding could be priced with a lag.
I'm pulling out the data for the 2008-9 that you're telling me about it. I have to really pull out the data, but just a few pointers in terms of how does our portfolio get impacted. Number one, as we stated in the past as well, that the transmission of any market rate change happens on our portfolio with a lag. So what we saw in an increase in the cost of funds in quarter 3 and now in quarter 4, and what I'm talking about in quarter 1, is with a lag. The RBI started increasing rates in April of last year. So April 2022 is when we saw the first increase in the repo rate. We didn't see an increase in our cost of funds till quarter 3. So it was almost after about 7 to 8 months that we first felt the impact of an increased market rate on our portfolio. The second point as to why did we feel it after 6 months and why are we not immune to it for another 12 months, 24 months, is because our liability portfolio largely comprises of short-term borrowings. And that's typically again to do with the kind of assets that we have. If you look at the asset breakup, almost about 39% is transactor. There is a revolver percentage, which again is short-term in nature. You don't really have too many chronic revolvers. So in order to have an ALM and in order to have a match funding position with respect to assets and liability, we've also been borrowing short. And which is why every 6 months, every 9 months, when the portfolio comes for a repricing, is when we're actually able to feel the impact of the market rate. So those are the two characteristics that I wanted to first lay out. As I said earlier, we've seen another rate hike in February. The impact of that will be felt as our portfolio comes, whatever amount of our portfolio comes for repricing in the first quarter. We've done some modeling around that, and we expect that increase is going to be about 10 to 15 basis points. I called out earlier that if there are no further rate hikes, we should see the cost of funds stabilize over the next 2 odd quarters. And if the market rates start to trend down from now onwards till the third quarter of this financial year, we will then see the impact of on the cost of funds where it starts to come down towards the end of this financial year. So you're absolutely right. It is with a lag. Because our portfolio gets repriced almost at about a 6 to an 8 month kind of a frequency, this is how we felt the impact of the market rate.
Thank you. Ladies and gentlemen, request you to restrict your question to only one at a time. You can join back the queue for follow-up questions. We have our next question from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah, hi, good evening. Ma'am, if I look at your cost of funds, it used to be 8% before COVID, and the policy rates was almost similar to the current levels. It used to be in the range of 8 to 8.5, right? And so what has fundamentally changed in your funding profile over the last 3-4 years so that your funding costs will remain, below pre-COVID levels?
I don't think we've mentioned that we're going to go. So we've said that the rates are going to go up.
This question is around with the policy rates remaining more or less at the same level. How are we confident about the trajectory being only limited to increase being limited to only 10-15 basis points? I think if you're comparing a situation 3 years back or 4 years back, I think the share of long term in our overall funding has increased over a period of last 4 years. From a 9-10% to 15% to now 35% in the overall. So that provides a kind of insurance against rate increases. So we have been steadily increasing, but of course, when the rates are peak, obviously we are looking at what is the right timing and what is the right instrument. So our endeavor is to continue to increase it in a meaningful way, in a very calibrated way, so as to insulate. But of course, as Rashmi has also said, we want to do the match funding and we want to get the opportunity of pricing it actually at the lowest rates whenever the market rates dip. So that's the fundamental difference between a 4 year back scenario and the current scenario.
So basically, your duration of your liabilities have come down over the last 3-4 years, right?
Duration of liabilities increased because long-term liabilities by way of NCDs of 3 years or otherwise subordinate bonds or kind of thing, maybe after 10 years what we raised. That rate has increased actually over a period of time.
But then I mean, if that is the case, don't you think then your funding cost can go back to 8% at some point of time, despite the current policy? The reason I'm asking is that
what you also need to take into account is what Mr. Rao just mentioned, that the increase in our long-term funding has happened in a scenario when the rates were lower. So we've been increasing our long-term funds post-COVID, and post-COVID the rates were low, and we are benefiting from that.
Okay. So basically you locked in a lot of funds at a very low rate and they are longer duration.
Yeah.
Is it? No, reason I'm asking this question is that generally, there is a tenure premium, right? So keeping everything else constant, if your tenure of liabilities are higher, the cost of funds should be higher. And as I said, at a similar repo rate, you had 8% cost of funds 3 years back or 4 years back, right? So, ideally, if your tenure has gone up, then at some point of time at the similar policy rate, your cost of funds can go back to 8%.
I mean, I think we'll have to go back and look at the numbers there. I mean, I do have the numbers for 2018-19. They are at about 7% odd. You also will have to look at the other things besides the repo rate, the credit premium, etc. as well, as to how were the credit premiums at that point in time for a AAA rated entity compared to where it is right now. So we'll have to look at all of those factors. But as I said earlier, that our modeling shows another 10 to 15 basis points stabilization, and beyond that, we'll have to see as to how the market reacts. As the credit premiums go up, obviously, even if the benchmark rates remain low, the credit premium will come and impact the cost of funds for SBI cards as well.
Okay, fair enough. Thank you.
Thank you. We have our next question from the line of Anand from HDFC Mutual Fund. Please.
Hello, ma'am. Can you hear me?
Yes, go ahead.
Yes.
Yeah. Ma'am, I just wanted to understand on the spend-based fee income, how should we look that going forward? As most of the spend category where the FDR are generally higher are opening up and we are seeing traction on that. Should we expect the spend-based fee income to grow higher than the overall spend next year?
How should we think about the spend-based income next quarter?
Mr. Anand, please mute your line because there's disturbance coming from your line.
Hello?
On the spend.
Yes, sir. Carry on.
Okay. Spend-based fee income is primarily the interchange that we earn from on the spending. It is dependent on the three elements, as we have always been stating: the mix of the categories in which the spend is happening, which kind of products, whether it is a premium product which is at the higher end of network spectrum or at the lower end, which card person is spending, and thirdly, whether it is a retail versus corporate mix. Because corporate typically, even though it gives you a higher interchange, but you have to do a pass back. So net margin, as we had stated, is very less. Over the last period during the COVID, we saw this interchange rates going down because people's consumption in the discretionary items was going down and non-discretionary was stable, where the interchange rates are typically lower. Now, as you have seen, there has been a marginal stability and some marginal increase in the of late as the travel has gone up, restaurants have gone up, last year those things have gone up. So what we see is futuristically for the next year, we believe that this rate will remain stable. There are some headwinds and there are some tailwinds. There are both positives and negatives which are happening in these categories. But broadly, we expect it to remain stable.
On the instance-based fee income, this quarter we have seen a sharp improvement. Do you think as we keep on charging more and more fee revenue, like fee on the rental, do we see this instance-based fee income to improve further, or?
We levied rental fee of 99 rupees from November of last year, and then we increased it from March 17th to 199. So 99, half of the last quarter was positively impacted by that, but you have to also recognize that the OVL fee was completely not there, which is also an instance-based fee in Q3. In Q4, we have seen a full benefit of 99 and half, almost 17 days benefit of 199. These are in line with what the industry is charging. Typically, the industry rate that's charging is 100 bits on the transaction, and we have seen that the average ticket size is around 20 to 21,000 rupees. So 199 is almost broadly in that range. It is in line with the industry average. We have not seen, as I stated earlier, a decline in the spend. Whether the spend will increase further or not, that is a matter of conjecture, but those little spends are stable at this.
So if I look at in terms of spend, instant-based fee income is approximately 1.2% of the spend this quarter. Should we assume this trend to sustain or to improve from here on?
It would not be on rentals. It will not be 1.2 because we get interchange on that also. Okay, it's not a zero interchange category. So there is an interchange also available, and after that we are now charging 199. So the number is higher. We believe that should remain stable in Q, at least in this quarter.
Perfect. So this year our operating profit growth was 17%. Despite the fact that we have seen significantly higher interest rate, we have seen lower revolve rate. How do you see this number going forward? Because interest rates will likely stabilize in the second half. And do you see some cost synergy also coming up for us?
I think you are talking about EBCC or operating profit.
Correct.
For the entire year, if you're correct, it is at 17%, but for the quarter alone, if you look at as compared to year-on-year basis, it's at 22%. So I think that way this quarter, last quarter itself, Q3 itself reflected a kind of, it absorbed the negative impact on account of all the some of the regulatory provisions which has impacted certain fee lines like OVL, etc. Then Q4, whatever steps we have taken, more or less it's reflective of what is the contribution from these new levies. So I think this, and with a kind of direction what we are aiming, where we want to optimize the cost, continue to focus on digital, increase the share of digital channels for sourcing, this will improve steadily. That's the kind. And overall, if you look at, deviating slightly away from this operating profit, overall return metrics, if you look at, the way to look at it is like a quarter to quarter, there will be fluctuations, even in operating profit, even in the ROE. But long-term averages, whatever we have earned, like a 5% plus 25%, near about 25% ROE, that will be maintained. That is the minimum aspiration.
Thank you. We have our next question from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening. I have two questions. One is like if you look at the new card sourcing, then over past 2-3 years, the mix of self-employed has risen to now 39%. It used to be in early 20s. And likewise, the mix of government employees has also reduced sharply. But the revolve rate isn't really picking up. In fact, it has only been like down since then. So is there any threshold that you would like to adhere to while broadening the risk filters to boost revolve rate?
What is the mode we are using for acquiring the self-employed? You can perhaps explain.
So basically for the self-employed customers, a lot of the self-employed actually comes from our banker channel, where we look at their saving account, current account behavior, and we onboard them. So it's a relatively better profile. We have a better visibility to the cash flow. So in that way, it's I would say it's a relatively a lesser risk. Lesser risk in terms of self-employed because it comes from the banker channel. In the open market also, we look at repayment performance in the bureau before we onboard self-employed customers. So all those checks are done in place, and so we have a better idea about the customer's repayment potential when you onboard self-employed customers.
Right, ma'am. So today the mix is like 61-39. Hello? Yeah. So this number, like, we are not looking to have any limit on this 39% self-employed, what we have reported this quarter.
Yeah, I think 39% is this quarter contribution, Rajesh? Yes.
We are putting any limit on this.
I think the way we are operating is like obviously we look at what is the potential, what is the customer choice, obviously, and what is the kind of channel we are using, etc. We take it into account. Of course, delinquency does matter, and the risk-adjusted profitability at the end of the day, finally that matters. So as long as all these metrics match and the acquisition is holding in terms of meeting all these expectations, we would like to continue. But to your question, other question around the revolver self-employed, because in as much as we are acquiring more of these customers through the banker channel, where we have an auto debit and auto sweep kind of facility, the revolver propensity will be lower for a self-employed acquired through banker channel.
Thank you. We'll take a last question from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my questions. Just one data question on, like, if you can share how many rental transactions happened on your platform over the last 3 months. And just to clarify on this instance-based fees of roughly 830 crores, is there any one-off, any element of seasonality, or any reason why it should dip next quarter if spends don't dip?
So I have already told you the average ticket size is between 20 to 22,000 rupees, and the weightage on spends is almost around mid-teens. So you can make an estimate on number of transactions.
Okay, fair enough. And on the next thing on instance-based fees?
Yeah, on the instance-based fee, as I called out earlier, that there is a provision of rental fee that's come in this quarter, which should stay or should stabilize or should stay at these levels only for the next few quarters as well. There is some milestone, incentive that we have gotten. I think that will normalize over the next few quarters. So while I think if I were to just look at from a BAU business perspective, this number should continue to grow. Will it see the kind of jump we've seen between quarter 3 and quarter 4? The answer is no. You'll see a more normalized increase going forward quarter on quarter.
Got it. That explains. Thank you so much and all the best.
Thank you. I would now like to hand the conference over to Mr. Rao for closing comments. Over to you, sir.
Yeah, let me thank our shareholders, investors, and business partners for their continued trust and support to us. I would also like to thank my colleagues at SBI Card for their continued commitment to ensure the company's success. I would like to highlight that SBI Card's strong focus on sustainability has helped it emerge stronger past any market turbulence. While we cannot control the external factors, but we do believe that our strong business model, our agility as a business, and adaptive approach equips us well to keep fueling our growth in the future. Thank you all for participating in this call.
Thank you. On behalf of SBI Cards and Payment Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.